Apple just reported its second quarter 2023 earnings, and as expected, the stock price did not do much. In this video, I will go over Apple's latest earnings and then do my own analysis of the company, which will include Apple's current valuation, analysis of the most important metrics, and a discounted cash flow analysis. I will also show you my brokerage account in real time, my own Apple investment, and what I plan to do with my position. The video will be full of information, so let's get right into it. What's up, strangers? Welcome to the Welcome Nation. My name is Vedo and I'm here to help you better understand the wealth game and become part of the Welcome Nation. As you can see, this is my own brokerage account. But before we dive into the specifics, I gotta make one thing crystal clear. I may have an opinion on a stock, but that is still an opinion and not financial advice. So don't go investing based on my blabbering. This is all for educational and entertainment purposes only, and when it comes to investing, no matter what anybody else says or does, you've gotta do your own research. Back to my brokerage account, my current portfolio balance is almost 94,000 euros. If you want a full review of my portfolio, go check out my portfolio reveal video, link is in the description of this video. Anyways, I have a relatively significant investment in Apple. As you can see here, I have around 6,353 euros in Apple. I'm currently sitting on 1,373 euros in gains, or 27%. If I click here and expand, we can see that I have been invested in Apple since September 2021. My average purchase price is around 130 euros. Apple makes around 6.5% of my current portfolio. I have bought Apple once for around 5,000 euros in September of 2021, and ever since then it's been sitting and I didn't touch it. The reason why I never touched Apple ever again after 2021 is because the price has never dropped significantly. So I didn't do any dollar cost averaging on Apple, and I used my money to average down on my other positions which were been going down. This article by CNBC reports that Apple beats soft expectations driven by 8% services growth. If we scroll further down in the article, we can see that Apple reported fiscal third quarter results that beat Wall Street expectation by both earnings and sales, driven by strong services sales that grew 8% on an annual basis. Overall sales fell 1% year over year, and revenue in the company's iPhone, Mac, and iPad lines were down from a year earlier. This means that Apple's revenue is down year over year is because sales in hardware have declined. However, if we scroll a little bit further down, we can see that Apple beat on their earnings per share. They reported $1.26 versus the estimations of $1.19. Revenue was reported with 81.8 billion versus expectation of 81.69. However, the revenue is down by 1% year over year. Here we can see that iPhone revenue declined by 2%, Mac revenue declined by 7%, and the iPad revenue declined by 20%. However, Apple's other product revenue is up 2%. Now we come to the interesting part. Apple has beat their expectation on services revenue, and the services revenue are up 8% year over year. Now this is the main growth driver for Apple. If we look at the overall revenue from 82 billion, the services portion of the revenue is 21 billion. That is around a quarter of the overall revenue. And this is where most people get Apple wrong. Apple is not a hardware company. Apple doesn't just create iPhones and Macs and iPads. The hardware part of Apple is just to get into the sticky part of Apple, which is the services. And the services entail things like the App Store, the iTunes Store, Apple Music, iCloud, Apple Pay, Apple TV Plus, Apple News Plus, Apple Arcade, Apple Fitness, and so on. So those are all the services that Apple keeps building and growing their customer base, enabled by their hardware sales. Last thing here, we can see that the gross margin is even better than expected with 44.5%. Now let's go to the Apple stock analysis. The website that you see here is a StockUnlock. I am not affiliated with this website at all. I just like its services and the guys who are building it. Here we can see that the Apple stock price is at an all-time high. We can see that the market cap of Apple is over 3 trillion. The PE for the trailing 12 months is almost 32. And the forward PE is around 29. Here we can see also the dividend is 0.5%. So people who invest in Apple do not invest in Apple because of the dividends. They invest in Apple because of the growth. If we look down here to the more important metrics, which is the price to free cash flow, the price to free cash flow is around 31. If we take 1 and divide by the 31 price to free cash flow, we get to around 3.2% free cash flow yield. Now, the free cash flow yield of 3.24% is not a good free cash flow yield. And the reason for that is that Benjamin Graham, the teacher of Warren Buffett and the grandfather of investing, who wrote the book The Intelligent Investor, talks about something called the risk premium. The risk premium ratio is simply when you take the free cash flow yield of a company and divided by the 10-year bond yield, which is considered risk-free. If we go now to the freeform tool and take Apple, and then we look at the 10-year bond yield, then free cash flow yield, and the risk premium, we can see that the risk premium is 0.79. As I said, we get this number by taking the free cash flow yield of 3.24 and divided by the 10-year bond yield, which is around 4%, and we get this 0.8 approximately. Benjamin Graham says that investors should be compensated for the risk they are taking, and the yield on their investments should be higher than what is considered a risk-free yield, which is the 10-year bond yield. As we see currently, Apple doesn't fulfill this criteria. Also, many other stocks in the stock market today do not fulfill this criteria. This is simply because of the environment that we find ourselves in, and that is, interest rates are high. There is a lot of debate going on whether we are in a recession, whether we are going into a recession, or whether we have just been in a recession. In either case, it's not an optimal environment for stocks. Going further, we will look at the revenue of Apple, the stock price, then free cash flow, and net income or earnings. So if we look at the last 10 years of Apple, we can see that revenue, the dark blue line, has been growing up steadily. And since around a year ago, Apple's revenue started coming down a little bit. The stock price, however, has been going up steadily at a much higher pace than the revenue. I know revenue is not the most important metric, but however, it's still good to look at it. What is an important metric is the free cash flow, and in Apple's case, also the net income. If we look at the dark green line and the light blue line, we can see that both lines are close to each other throughout history. That tells me that we can take either one of the two metrics for evaluating Apple. If we look down at the table, we can see that the free cash flow has been growing 8% compounded annual growth rate, the net income around 9%, the revenue has been going up also around 9%, so all three of them are around 8 and 9. However, the stock price has been going up by 27%. That tells me that Apple as a stock is getting much more expensive. Or differently said, investors are willing to pay a much higher price for Apple than they were in the past. So it looks to me that Apple's price is outpacing the fundamentals by a whole lot. Another way to evaluate Apple is to look at the stock price, then look at the shares outstanding, then look at the free cash flow per share, and look at the two price ratios, price to free cash flow and price to earnings, so PE. So if we look at the last 5 years or so and scroll down to the table, we can see that Apple has been doing share buybacks at around 5% compounded annual growth rate, and the free cash flow per share has been growing by around 18%. That makes around 23% growth rate. However, the stock price has been going up by 32%. This is what I mean. The stock price is outpacing the fundamentals. So where does the delta come from? The delta comes from the expansion of the price ratios. So we can see that the PE and the price to free cash flow has been growing around 13%, which illustrates my point even further, that investors are willing to pay more for Apple now than they were in the past. They are bidding the stock price up. Now lastly, we will look at the discounted cash flow analysis. As we have established, for Apple we can use free cash flow or net income. Let's stick with the free cash flow for now. And if we look at all the data that has been pre-filled by the tool, we look at the next 5 years. The metric growth rate is around 8.74%. The share buybacks for the last 5 years is around 4%. And the price ratio, price to free cash flow, is around 21. If we're looking at discount rate, which is the average annual return rate from the broad market index, for example, the S&P 500, we can see that Apple's fair price is 17% under the current stock price. If Apple was to reach these goals, that means that Apple's stock price would be going up by less than 6% on a compounded annual growth rate. These are subpar returns. If we say that Apple is an outstanding, wonderful business and Apple is going to reach this goal, and we can say that Apple will be trading at a 26 price to free cash flow, as investors are paying a premium for this company, we can see that these are the conditions that Apple would need to meet in order to justify current stock price. And if you were to play the devil's advocate and you say the next 5 years are not going to be as prosperous as the past, and if we dial down just a little bit, let's say 8% annual free cash flow growth rate, they're going to buy back shares at around 3%, and the price ratios are going to return to their, let's say, close to the historical values, around 21, let's call it 22. With these assumptions, we see that Apple is even more overvalued today. So looking at this data, in my opinion, Apple is not a stock that's going to get anybody rich quick. Nobody's going to get rich with Apple overnight. There's simply high expectation in this company. In conclusion, I would like to say that for me, Apple is a high conviction position. Apple is a technology giant known for its consumer electronics, software, and services. With a robust product ecosystem, it has a strong customer base and enjoys brand loyalty. Its revenue, net income, and free cash flow has shown consistent growth over the years, driven by the popularity of its iPhone, iPads, and other devices and services. Apple maintains a low debt-to-equity ratio, which is indicating a strong financial position. So even though I previously said that I believe that Apple is overvalued and I'm up on my position and I believe that it will not make anybody rich quick, I do not want to trade and speculate this position. Just because the stock price is high right now, I do not want to sell my position and hope that the stock will go down and I will buy back in again at a later point in time. Apple is simply not a company that you bet against. If I sell and then the price and the price ratios never compress that much that I get back into the position, that will be my loss. So I will hold my position as long as the fundamentals are intact, and if due to some other factors the price drops and the price ratios compress, I will add more shares. For now, I will just hold and do nothing. So there you have it. That was my Apple stock analysis. I hope you found this video informative. If you have any questions or comments, please leave them down below. And if you're not already subscribed to my channel, please hit the subscribe button and share this video with your friends and family. That means so much to me. I will do my best to create regular videos and update my portfolio. I will do more fundamental analysis and review other companies, their earnings, other investors buys and sell, and everything else around investing. Thank you so much for watching, and I'll see you in my next video.